Well, gold is up by over 1,200% since the end of the 1990s. Stocks, S&P 500 at least, up by a little bit less than 630%. Fixed income, as measured by the Bloomberg Ag, up by a little bit less than 180%, and home prices, as proxied by the Case-Shiller index, up by a little bit more than 230%. And again, these are cumulative numbers over a period of a little bit more than 25 years. So it's been quite a run for gold prices. And admittedly, whenever you put together a chart like this or an analysis like this, your starting point very much matters. So we should acknowledge that here. At the end of the 1990s, as we just alluded to with the prior chart, the equity market was coming towards the end of an historic run, and we had a big bear market in front of us, not only the bear market from 2000 to 2002, but we relatively shortly thereafter, fell into a bear market in 2007 that was long and deep as well. Had another bear market, of course, in 2020, and then another one in 2022. So the starting point for stocks was not great. The starting point for commodities was pretty good. Commodities were weak for the most part in the late 1990s, so a good launching point. But even still, you see how much gold has outperformed all other commodities, and outside of cocoa, copper, and silver, outperformed to a substantial degree other commodities, even though many of these individual commodities were also weak in the late 1990s. So a very curious time to be advocating for a move into gold after a structural run of this nature. Commodities historically move in long-term super cycles. They're not cyclical in the same way that equities are cyclical, fixed income is cyclical, or home prices are cyclical. They tend to be super cyclical. And we've had, especially for gold, a very strong super cycle. So we would advocate caution for those, especially looking out over the next 10, 20, 25 years, those who might be thinking about moving into an area that already has done quite well over the long haul.